Welcome to the world of personal finance. In simple terms, personal finance means managing your money to achieve your financial goals. It includes how you earn money, spend it, save it, invest it, and protect it. Understanding personal finance is important because it helps you make smart decisions about your money. Whether you're a student, a worker, or a business owner, personal finance affects your daily life. Let's start with income. Income is the money you earn. This could be from a job, a business, or any other source. Managing your income wisely is the first step in personal finance. Next is budgeting. A budget is a plan that shows how you will spend your money. It helps you keep track of your income and expenses. By creating a monthly budget, you can avoid overspending and start saving. Saving is the habit of keeping aside a part of your income for future use. It's one of the most powerful tools in personal finance. Even small amounts saved regularly can grow into a large amount over time. Savings can help during emergencies, plan for a vacation, or buy something important. Now let's talk about debt. Debt means borrowing money. While some types of debt like education loans or home loans can be helpful, too much debt can be harmful. It's important to borrow only what you can repay and always pay on time. Investing is another key part of personal finance. Investing means using your money to buy assets that grow in value over time, like stocks, bonds, or property. It helps your money grow faster than just saving it in a bank. Also, don't forget about insurance. Insurance protects you from financial loss due to unexpected events like illness, accidents, or theft. Health insurance, life insurance, and vehicle insurance are some common types. Finally, financial goals are the things you want to achieve with your money. These can be short-term goals like buying a phone, or long-term goals like saving for retirement. When you manage your money wisely, you can achieve your goals faster and with less stress. In summary, personal finance is all about making smart money choices. Learn to earn, spend, save, invest, and protect your money. Start now and you'll be better prepared for a secure and successful future. Understanding how money flows in and out of your life is the first step to managing your personal finances. It all starts with two basic things: income and expenses. Income is the money you earn. It can come from different sources. For most people, income comes from a job, business, or freelancing. But income can also come from other places like rent from property, interest from savings, or money from investments. No matter the source, income is the money that comes into your pocket. Now let's talk about expenses. Expenses are the money you spend. This includes your basic needs like food, rent, electricity, internet, and transport. It also includes things like shopping, entertainment, or subscriptions. Some expenses are fixed, like rent. You pay the same every month. Others are variable, like groceries or fuel. They change month to month. When you understand your income and expenses clearly, you can plan better. You can see if you are spending more than you earn or if you are saving money each month. Let's take a simple example. Imagine you earn $2,000 every month. You spend $800 on rent, $300 on food, $100 on transport, $100 on bills, and $200 on other things. That adds up to $2,500. That means you have $500 left. That is your savings or extra money. But if your expenses are higher than your income, like if you spend $2,200 every month but only earn $2,000, then you are in trouble. You may start borrowing money or using credit, which can lead to debt. That's why tracking income and expenses is very important. You can use a notebook, a spreadsheet, or an app. Write down every income and every expense. At the end of the month, see where your money is going. You might be surprised at how small things add up, like daily coffee or weekend food delivery. Understanding your income and expenses helps you control your money instead of letting money control you. It helps you plan for the future, reduce stress, and reach your financial goals. Start today. Know your numbers and take the first step toward financial freedom. Many people earn money but still struggle to save or manage it well. The main reason? They don't have clear financial goals. Setting financial goals means deciding what you want to achieve with your money. It gives you direction and helps you stay focused. There are three types of financial goals: short-term, mid-term, and long-term. Short-term goals are things you want to achieve soon, usually within a year. Examples include saving for a new phone, paying off a small debt, or building an emergency fund. Mid-term goals are things you plan to do in the next 1 to 5 years. These could be saving for a vacation, buying a motorcycle, or starting a small business. Long-term goals take more time, usually more than 5 years. These include buying a house, planning for your child's education, or saving for retirement. Now let's talk about how to set these goals properly. Step 1. Be specific. Instead of saying I want to save money, say I want to save 1 lakh taka in 12 months. Step 2. Make your goals measurable. This means setting numbers and deadlines. For example, save 10,000 taka every month for 10 months. Step 3. Make them realistic. Don't try to save too much too fast. Your goals should match your income and lifestyle. Step 4. Write them down. Keeping your goals in your mind is not enough. Write them on paper or use an app. Step 5. Track your progress. Every week or month, check how much you've saved. This keeps you motivated and helps you adjust your plan if needed. Here's a simple example. Let's say you want to buy a laptop in 6 months that costs 60,000 taka. Divide the total by 6. That means you need to save 10,000 taka every month. Cut down on extra spending and put that money in a separate savings account. If you follow your plan, you'll reach your goal. Remember, financial goals are not only for the rich. Anyone, even with a small income, can set goals and achieve them with discipline and patience. Start small, stay consistent, and review your goals often. This is how you take control of your money and build a better future. Creating a budget is one of the most important steps you can take to gain control over your money. It helps you understand where your money is going and allows you to make smart financial decisions. Let's start with the basics. A budget is a simple plan for how you will spend and save your money each month. It helps you track your income and expenses, so you can avoid overspending and save for the future. Step 1. Know your income. First, calculate your total monthly income. This includes your salary, freelance work, side gigs, or any regular money you receive. Use your net income, which is the amount you take home after taxes and deductions. Step 2. Track your expenses. Next, write down all your monthly expenses. Start with fixed expenses. These are things that don't change each month, like rent, loan payments, or internet bills. Then list your variable expenses. These change from month to month, like groceries, entertainment, or transportation. Be honest and thorough. Check your bank statements or apps to see your spending habits. Step 3. Categorize and compare. Now organize your expenses into categories such as housing, food, utilities, savings, and fun. Then compare your total expenses to your income. Are you spending more than you earn? If yes, it's time to cut back. If you're spending less than you earn, that's great. You can use the extra money to save or pay off debt. Step 4. Set financial goals. Decide what's important to you. Do you want to build an emergency fund, save for a vacation, or pay off your credit card? Setting clear goals gives your budget purpose. Break them into short-term and long-term goals. Step 5. Create and stick to your budget. Now assign specific amounts to each expense category based on your income and goals. This is your actual budget. Try to follow it each month. Use tools like spreadsheets or budget apps to stay on track. If something doesn't work, adjust it. Budgets are flexible. Life changes, and so can your plan. Final tip: review. Regularly. Every month, review your budget. See what worked and what didn't. This habit helps you stay in control and make better choices over time. Conclusion. Budgeting isn't about restricting your life, it's about making your money work for you. With a simple plan and regular review, you can build better habits, avoid debt, and reach your financial goals. Start today. Your future self will thank you. Imagine suddenly losing your job or facing a medical emergency. What would you do? How would you manage your daily expenses? That's where an emergency fund comes in. An emergency fund is money set aside to cover unexpected expenses. It helps you avoid going into debt when life throws surprises your way. It gives you peace of mind and financial stability during tough times. The first step is understanding how much you need. A good rule of thumb is to save enough to cover 3 to 6 months' worth of living expenses. This includes rent, groceries, utilities, transportation, and any essential bills. Start small. You don't need to save everything at once. Begin with a goal of $500 or $1,000. Break it down further. Can you save just $50 a month? Even $10 a week adds up over time. Make saving automatic. Set up a separate savings account just for emergencies. Arrange an auto transfer from your main account every month or right after payday. This way you don't have to think about it and the money grows quietly in the background. Cut back on small expenses. Skip the extra coffee or reduce eating out for a few weeks. Use the money you save to add to your emergency fund. Sell unused items online. take on a side gig, or redirect bonuses and tax refunds. Your emergency fund should be easy to access in case of a real need, but it shouldn't be so easy that you dip into it for non-essentials. Avoid investing this money in risky places. Keep it in a high-interest savings account if possible. Remember, the goal is to be prepared, not perfect. Don't worry if you have to use your emergency fund. That's exactly what it's for. Just be sure to rebuild it afterward. Start today, even with a small amount. Over time, those small steps create a big safety net. Your future self will thank you. Most people want to save money, but many don't know where their money actually goes. Tracking your spending is the first step to gaining control over your finances. When you track your spending, you become more aware of your habits. It's easy to spend small amounts on coffee, snacks, or online shopping without realizing how much it adds up at the end of the month. These small expenses can silently eat into your budget. By tracking your spending, you can clearly see which areas take up the most of your money. This helps you identify which expenses are necessary and which ones you can reduce or eliminate. It also helps you stay within your budget. When you know exactly how much you've spent, you're less likely to overspend. You start making more thoughtful decisions with your money. Another benefit is reaching your financial goals faster. Whether you want to pay off debt, save for a vacation, or build an emergency fund, knowing where your money goes allows you to plan better and save more efficiently. There are many ways to track your spending. You can use a simple notebook, a spreadsheet, or a budgeting app. What matters is consistency. Record your expenses daily or weekly to stay updated and avoid surprises. Over time, tracking your spending helps you build better financial habits. You become more disciplined, more organized, and more confident in handling money. In short, tracking your spending is a small habit that can lead to big changes in your financial life. It brings clarity, control, and peace of mind. The earlier you start, the sooner you'll see the benefits. Debt can feel overwhelming, but with the right strategies, it is possible to take control and reduce financial stress. Managing debt effectively starts with understanding your financial situation clearly. Begin by listing all your debts. Include credit cards, personal loans, mortgages, and any other borrowed money. Write down the total amount owed, the interest rate, and the minimum monthly payment for each. This will give you a full picture of your debt. Next, create a monthly budget. Track your income and all your expenses. Identify areas where you can cut back. Even small changes like eating at home more often or canceling unused subscriptions can free up money to put toward debt repayment. Once you know how much you can afford to pay, choose a repayment strategy. Two popular methods are the debt snowball and the debt avalanche. The debt snowball method means paying off the smallest debt first, then moving on to the next smallest. This helps you build motivation with small wins. The debt avalanche method focuses on paying off the debt with the highest interest rate first. This saves you more money in the long run by reducing interest charges. Choose the method that works best for your mindset and situation. Always make at least the minimum payment on all debts to avoid penalties, but focus extra money on one debt at a time according to your chosen method. If your debt feels unmanageable, consider speaking to a credit counselor. They can help you create a realistic plan, sometimes negotiate lower interest rates, or combine your debts into a single monthly payment through a debt management plan. Avoid taking on more debt while you're trying to pay it off. Stop using credit cards unless absolutely necessary. Use cash or debit to stay within your budget. Try to increase your income if possible. Consider part-time work, freelance opportunities, or selling unused items. Every extra dollar can help reduce your debt faster. Stay consistent and be patient. Paying off debt takes time, but every payment brings you closer to financial freedom. Remember, managing debt is not just about numbers. It's also about changing habits and making better financial decisions for the future. Start today. Your future self will thank you. What is a credit score and why does it matter? A credit score is a 3-digit number that shows how trustworthy you are when it comes to borrowing money. It's like a financial report card. The higher the number, the better your chances of getting loans, credit cards, or even renting a home. Most credit scores range between 300 and 850. A score above 700 is generally considered good, while a score above 800 is excellent. If your score is below 600, it may be hard to get approved for loans or credit. Your credit score is calculated based on your credit report. But what's a credit report? A credit report is a detailed record of your credit history. It includes information like how many loans or credit cards you have, how much money you owe, whether you pay your bills on time. If you've ever missed payments or defaulted on a loan, there are three major credit bureaus that create your credit report: Equifax, Experian, and TransUnion. Lenders check your report from these agencies before deciding whether to give you credit. Let's look at the 5 main factors that affect your credit score. Payment history. This is the most important factor. Lenders want to see if you pay your bills on time. Even one missed payment can lower your score. Credit utilization. This means how much of your available credit you're using. Try to keep it below 30%. For example, if you have a credit limit of $1,000, try not to use more than $300. Length of credit history. The longer you've had credit accounts open, the better. It shows experience in handling credit. New credit. Applying for too many loans or credit cards in a short time can hurt your score. Credit mix. Having a mix of credit types like a credit card and a car loan can help your score. Now that you understand credit scores and reports, how can you improve your score? Pay all your bills on time. Pay off debts and keep your credit card balance low. Don't open too many new accounts at once. Check your credit report for errors and report them. You can check your credit report for free once a year from each of the 3 credit bureaus. Go to annualcreditreport.com to get your reports. It's a good habit to check your report and make sure everything is accurate. Understanding your credit score and credit report is the first step toward better financial health. It can help you qualify for better interest rates, save money, and open new opportunities in the future. If you're struggling with multiple debts, you might be looking for a strategy to help you take control. 2 popular methods people use are debt consolidation and the debt snowball method. Both aim to help you pay off debt faster, but they work in very different ways. Let's break them down. Debt consolidation means combining all your debts into one single loan. This could be a personal loan, a balance transfer credit card, or a debt consolidation program. The idea is simple. Instead of managing several payments with different interest rates, you just pay one monthly amount. For example, if you have 3 credit cards with different balances and interest rates, you could take out a loan to pay them all off. Now you only have one payment to focus on. Ideally, the new loan has a lower interest rate, which means you save money in the long run. The benefits of debt consolidation include simplified payments, possibly lower interest rates, and a clear end date for your debt. But it's important to qualify for a good loan. If your credit score is low, you might not get a better interest rate. Also, if you don't change your spending habits, you could end up with more debt again. Now let's talk about the debt snowball method. This method focuses on paying off your smallest debt first while making minimum payments on the rest. Once the smallest one is paid off, you move on to the next smallest. Each time you pay off a debt, your confidence grows like a snowball, rolling and getting bigger. Here's how it works. Imagine you have 4 debts: $300, $1,000, $20,500, $5,000. You start with the $300 debt. You pay as much as you can on it, while making minimum payments on the others. Once that's paid off, you move to the $1,000 one, and so on. The biggest advantage of this method is the motivation. Paying off a debt completely, even a small one, feels like a win and pushes you to keep going. It's all about building momentum. But there's a downside. The snowball method doesn't consider interest rates, so you might pay more in the long run compared to other strategies, especially if your larger debts have high interest. So which method is better? That depends on your situation. If you need a single payment and a lower interest rate, debt consolidation might be the right path. But if you need motivation and small wins to stay on track, the debt snowball method could work better for you. Before choosing a method, take a close look at your debts, interest rates, and personal habits. What matters most is sticking to a plan and not giving up. Debt freedom is possible step by step. Welcome. Today we will learn how to create a personal finance plan that helps you manage your money better and reach your financial goals. Step 1. Understand your income. First, know exactly how much money you earn. This includes your salary, any side income, bonuses, or other sources. Write down your total monthly income. This will be the base for your plan. Step 2. Track your expenses. Next, track where your money goes each month. List your regular expenses like rent, utilities, groceries, transport, and subscriptions. Also, include occasional costs like gifts or repairs. Tracking helps you see your spending habits clearly. Step 3. Set your financial goals. Decide what you want to achieve with your money. It could be saving for an emergency fund, paying off debt, buying a house, or investing for the future. Set short-term and long-term goals that are realistic and specific. Step 4. Create a budget. A budget is a simple plan for how you will spend and save your money. Start by allocating money for needs like bills and food. Then set aside an amount for savings and debt payments. Finally, assign some money for wants and leisure. Make sure your spending does not exceed your income. Step 5. Build an emergency fund. An emergency fund is money saved to cover unexpected expenses. Aim to save at least 3 to 6 months' worth of living costs. This fund provides financial security and peace of mind. Step 6. Manage debt wisely. If you have debt, plan to pay it off as soon as possible. Focus on high-interest debts first. Avoid adding new debt unless absolutely necessary. Reducing debt improves your financial health. Step 7. Monitor and adjust your plan. Review your finance plan every month. Compare your actual spending with your budget. If you find areas where you overspend, adjust your budget. Your financial plan should be flexible and change as your life changes. Step 8. Stay consistent and patient. Personal finance is a long-term journey. Stay consistent with your budget and savings. Celebrate small wins and keep working towards your goals. Over time, you will see progress and build financial stability. That's it. Follow these simple steps to create a strong personal finance plan. Start today and take control of your money for a better future. Saving and investing are two important ways to manage your money. Both help you reach your financial goals, but they work differently. Understanding the basics can help you make smarter decisions about your money. What is saving? Saving means putting money aside for future use. This money is usually kept in a safe place, like a bank savings account. The main goal of saving is to keep your money safe and have it ready when you need it. Savings are best for short-term goals. For example, saving for a vacation, an emergency fund, or a new gadget. When you save, your money grows slowly because banks pay you a small amount of interest, but your money is easy to access anytime. What is investing? Investing means using your money to buy things like stocks, bonds, or real estate. The goal is to grow your money over time by earning a profit. Investing usually carries more risk than saving, but it can also offer higher rewards. Investing is good for long-term goals like buying a house or preparing for retirement. Your investments can increase in value, but there is also a chance you could lose money. It's important to understand the risks before investing. Why save and invest? Saving and investing work together to help you build wealth. Saving gives you a safety net for emergencies and short-term needs. Investing helps your money grow so you can meet bigger goals in the future. Start by saving a little money regularly. Once you have some savings, think about investing to make your money work harder. The earlier you start investing, the more time your money has to grow. Tips for saving and investing. Set clear goals. Know what you want to save or invest for. Create a budget to track your income and expenses. Save before you spend. Treat saving like a monthly bill. Learn about different investment options before putting your money in. Diversify your investments to reduce risk. Be patient. Investing is a long-term process. Summary: saving keeps your money safe and ready for short-term needs. Investing helps your money grow for the future but comes with some risk. Both are important to reach your financial goals. Start saving today and consider investing when you are ready to grow your money. Bank accounts are essential tools for managing money. Different types of bank accounts serve different purposes. Understanding these accounts helps you choose the right one for your needs. Savings account. A savings account is designed for saving money. It offers interest on the balance, helping your money grow over time. This account is useful for emergencies, short-term savings, or building an emergency fund. You can deposit and withdraw money easily, but there may be limits on the number of withdrawals. Current account. A current account, also called a checking account, is mainly for businesses or people who make frequent transactions. It allows unlimited deposits and withdrawals. Unlike a savings account, it usually does not offer interest. This account is ideal for daily spending, paying bills, and business transactions. Fixed deposit account. A fixed deposit account locks your money for a fixed period like 6 months, 1 year, or more. The bank pays higher interest compared to savings accounts because your money stays deposited for the set time. This account is suitable for people who want to earn better interest and do not need immediate access to their money. Recurring deposit account. A recurring deposit allows you to save a fixed amount every month for a specific period. At the end of the term, you get the total amount saved plus interest. This is a good option for people who want to develop a regular saving habit. NRI account non-resident Indians. NRIs can open special bank accounts in their home country. These accounts help manage income and savings from abroad. There are different types like NRE, non-resident external, NRO, non-resident ordinary, and FCNR, foreign currency non-resident accounts, each with specific uses. Summary savings accounts are for everyday saving with interest. Current accounts are for frequent transactions, mainly business-related. Fixed deposits give higher interest for locking money for a fixed time. Recurring deposits help save regularly every month. NRI accounts help people living abroad manage money in their home country. Choosing the right bank account depends on your financial goals and needs. Knowing these types helps you use your money wisely and grow your savings effectively. Building good credit is important for your financial future. It helps you get loans, rent apartments, and sometimes even get jobs. But building credit takes time and responsibility. Here are the simple steps to build your credit the right way. Step 1. Understand what credit is. Credit is your ability to borrow money and pay it back on time. When you borrow and repay responsibly, lenders trust you more. This trust is shown as a credit score, a number that shows how reliable you are. Step 2. Start with a credit card or loan. If you don't have credit yet, the easiest way to start is with a credit card or a small loan. A secured credit card where you put down a deposit is a good choice for beginners. Another option is a credit builder loan from a bank or credit union. Step 3. Use credit but don't overspend. Use your credit card for small purchases that you can pay off every month. Avoid spending more than you can afford. Keep your credit card balance low, ideally below 30% of your credit limit. Step 4. Always pay on time. Paying your bills on time is the most important part of building good credit. Late payments hurt your credit score and can lead to fees. Set reminders or automatic payments to never miss a due date. Step 5. Keep old accounts open. Length of credit history matters. Even if you don't use an old card often, keeping it open helps your credit score. Closing accounts can lower your score. Step 6. Avoid opening too many accounts at once. Every time you apply for new credit, it shows up as a hard inquiry and can lower your score temporarily. Only apply for credit when you really need it. Step 7. Check your credit report regularly. You have the right to check your credit report for free once a year from major credit bureaus. Make sure all the information is correct. Report any errors you find immediately. Step 8. Be patient. Building credit doesn't happen overnight. It takes months and sometimes years of good habits to build a strong credit history. Summary. Understand credit and credit scores. Start with a secured credit card or small loan. Use credit wisely and keep balances low. Always pay bills on time. Keep old accounts open. Don't apply for too much credit at once. Check your credit report regularly. Be patient and consistent. Building credit responsibly opens many doors in life. Follow these steps and you will build a strong credit foundation for your future. Saving money on daily expenses can make a big difference over time. Here are some smart ways to keep more cash in your pocket without feeling like you are sacrificing too much. Plan your meals and cook at home. Eating out or ordering food is often expensive. By planning your meals for the week and cooking at home, you save money and eat healthier. Make a grocery list before shopping and stick to it. Avoid buying unnecessary snacks or impulse items. Use coupons and discounts. Always look for coupons, discount codes, and sales before making a purchase. Many stores have apps or websites with digital coupons that are easy to use. Even small discounts add up when you shop regularly. Cut down on utility bills. Simple habits like turning off lights when not in use, unplugging devices, and using energy-efficient bulbs can lower your electricity bill. Also, fix any leaks to reduce water waste. Small changes at home save money every month. Buy generic or store brands. Many store brands offer the same quality as popular brands but cost less. Try switching to generic products for groceries, cleaning supplies, and personal care. This small change can save you a significant amount over time. Limit impulse purchases. Before buying something, ask yourself if you really need it. Waiting 24 hours before making non-essential purchases helps reduce impulse spending. This pause can stop unnecessary expenses. Use public transport or carpool. If possible, use public transportation or carpool to work or school. This can save you money on fuel, parking, and car maintenance. Walking or biking for short trips is also a good way to save and stay healthy. Cancel unused subscriptions. Check your monthly subscriptions and memberships. Cancel those you do not use often, such as streaming services, magazines, or gym memberships. This simple step can free up money every month. Shop secondhand. For items like clothes, furniture, or electronics, consider buying secondhand. Thrift stores, online marketplaces, and garage sales offer quality items at lower prices. Set a budget and track spending. Create a simple budget to keep track of your income and expenses. Knowing where your money goes helps you identify areas to cut back and save more. Save small amounts regularly. Even saving a little money each day adds up. Put aside small amounts in a savings jar or a bank account. Over time, these savings will grow and help with unexpected expenses. Saving money is about making smart choices every day. Try these tips and watch your savings grow without feeling stressed. Small changes lead to big results. Taxes are money that individuals and businesses pay to the government. This money helps fund important services like schools, roads, hospitals, and public safety. There are different types of taxes. The most common are income tax, sales tax, and property tax. Income tax is money paid on the money you earn from your job or business. Sales tax is added when you buy goods or services. Property tax is based on the value of your home or land. Understanding how taxes work is important because taxes affect how much money you keep. If you don't manage your taxes properly, you might pay more than necessary. This is where tax planning comes in. Tax planning means organizing your finances in a way that reduces the amount of tax you have to pay legally. It helps you keep more of your hard-earned money. One important part of tax planning is knowing about deductions and credits. A deduction reduces the amount of income that is taxed. For example, if you spend money on education or healthcare, you might qualify for deductions. Tax credits are even better because they reduce the tax you owe directly, sometimes giving you money back. Another tax planning tip is to keep good records. Save receipts, bills, and documents that prove your expenses. This helps you claim deductions and avoid problems if the tax office asks questions. Timing can also matter. For example, if you expect your income to be higher next year, you might want to delay some income or expenses to reduce your taxes in the current year. Investing in retirement accounts like 401k or IRAs can also reduce taxable income. These accounts let you save money for the future while lowering your tax bill today. It's important to file your taxes correctly and on time. Missing deadlines can lead to penalties and extra charges. In summary, taxes are a part of life, but smart tax planning helps you pay only what is required. By understanding your taxes, using deductions and credits, keeping good records, and planning your income and expenses, you can reduce your tax burden. Take control of your finances by learning about taxes and planning ahead. This way you keep more money in your pocket and avoid surprises when tax season comes. Inflation is a term that you hear a lot, but what does it really mean? Simply put, inflation is the rate at which the prices of goods and services increase over time. When inflation happens, your money loses some of its value because things cost more than before. For example, if a loaf of bread costs $1 today and the inflation rate is 5% per year, next year the same loaf might cost $1.05. That means you need more money to buy the same things. Inflation affects almost everything in your daily life. It impacts how much you pay for groceries, gas, clothes, and even services like healthcare and education. But inflation doesn't just affect prices. It also influences your personal finances in several important ways. First, inflation reduces your purchasing power. This means the money you have today will buy less in the future. If your income doesn't increase at the same rate as inflation, you might find it harder to maintain your current lifestyle. Second, inflation can affect your savings. If you keep your money in a simple savings account with a low interest rate, inflation can eat away the real value of those savings. For example, if your savings earn 2% interest but inflation is 4%, your money effectively loses value over time. Third, inflation impacts loans and debts. If you have fixed-rate loans, inflation can actually work in your favor because you repay your debt with money that is worth less than when you borrowed it. However, if interest rates rise due to inflation, new loans could become more expensive. So how can you protect your finances from inflation? One way is to invest in assets that tend to keep up with or beat inflation, like stocks, real estate, or inflation-protected bonds. These investments have the potential to grow over time, and help maintain the value of your money. Another important step is to budget wisely. Track your expenses and try to avoid unnecessary spending, especially when prices are rising. Increasing your income through skill development or side jobs can also help you stay ahead of inflation. Finally, review your financial plan regularly. Inflation rates change over time, so updating your goals and strategies helps you stay prepared for any financial challenges. In summary, inflation means rising prices that reduce the value of your money. It affects your buying power, savings, and debt. Being aware of inflation and planning your finances accordingly can help you protect your money and secure your financial future. Welcome. Today we will talk about simple investment strategies that anyone can use to start growing their money. Investing means putting your money into things that can make more money over time. It is a great way to build wealth and reach financial goals. But if you are new to investing, it can feel confusing. Let's break it down into easy steps. First, understand your goals. Ask yourself, why do I want to invest? Is it for retirement, buying a house, or maybe for education? Knowing your goal helps you choose the right investment plan. Next, learn about risk. Every investment has some risk. Risk means the chance of losing money. Usually, the higher the risk, the higher the reward. But high risk can also mean big losses. As a beginner, it is better to start with lower risk investments. One popular way to start is investing in stocks. Stocks are shares of a company. When you buy a stock, you own a small part of that company. Stocks can grow in value over time, but they can also go down. To reduce risk, do not put all your money in one stock. Instead, buy different stocks in many companies. This is called diversification. Another option is mutual funds or exchange-traded funds called ETFs. These are groups of stocks or bonds combined into one investment. Buying a mutual fund or ETF helps you diversify without buying many individual stocks. You can also consider bonds. Bonds are loans you give to governments or companies. They pay you interest over time. Bonds are usually safer than stocks but offer smaller returns. A very important strategy is to invest regularly. This is called dollar cost averaging. It means you invest a fixed amount of money every month, no matter if prices are high or low. This way you buy more shares when prices are low and fewer when prices are high. It helps reduce the effect of market ups and downs. Remember to keep a long-term view. Investing is not about quick money. Markets can go up and down every day, but over years they usually grow. Stay patient and do not panic when prices fall. Also, keep some money as emergency savings before investing. This will keep you safe in case of unexpected expenses. Finally, educate yourself. Read books, watch videos, and learn from reliable sources. The more you know, the better decisions you can make. To sum up, set clear goals. Understand your risk. Diversify your investments. Invest regularly. Think long-term. Keep emergency savings. Keep learning. Start small and grow your investments step by step. Investing is a journey, and with the right strategies, you can reach your financial goals. Thank you for watching. Start your investment journey today. The stock market is a place where people buy and sell shares of companies. These shares represent small parts of a company. When you own a share, you own a small part of that company. The main goal of investing in the stock market is to make money. You can earn money in two ways. First, when the price of the shares goes up and you sell them for more than you paid. Second, some companies pay dividends, which is a share of their profits paid to shareholders. Before you start investing, it is important to understand a few basic terms. A stock or share is a piece of ownership in a company. A broker is a person or company that helps you buy and sell stocks. The stock exchange is the place where stocks are bought and sold. Examples include the New York Stock Exchange and NASDAQ. To get started, first you need to open a brokerage account. This is like a bank account but for buying and selling stocks. There are many online brokers that make it easy to open an account. When choosing a broker, look for low fees, easy-to-use platforms, and good customer support. Next, decide how much money you want to invest. It is best to start small and only invest money that you can afford to lose. The stock market can be risky and prices can go up and down. After you have an account and money to invest, start by researching companies you know and understand. Look at their business, products, and how they make money. Also, check their financial health, such as profits and debts. It is good to diversify your investments. This means buying shares in different companies or industries. Diversification helps reduce risk because if one company does poorly, Others may do well. Many beginners also choose to invest in mutual funds or exchange-traded funds, ETFs. These funds pool money from many investors to buy a wide variety of stocks. This is an easy way to get diversification without buying many individual stocks. Finally, remember that investing is a long-term activity. Stock prices can be volatile in the short term, but over time, investing can help you grow your money. Avoid trying to time the market or make quick profits. Instead, be patient and keep learning. To summarize, learn basic stock market terms. Open a brokerage account. Start with a small investment. Research and choose companies carefully. Diversify your investments. Think long-term and be patient. With these simple steps, anyone can get started in the stock market. Start today and watch your money grow over time. Investing money wisely is one of the best ways to build wealth over time. One of the most powerful tools investors have is called compound interest. But what exactly is compound interest, and why is it so important? Compound interest means earning interest on both the money you put in and on the interest you have already earned. It is sometimes called interest on interest. This process helps your money grow faster and faster the longer you leave it invested. Here's an example. Imagine you invest $1,000 with a 5% interest rate per year. After 1 year, you earn 5% of $1,000, which is $50. Now in the second year, you earn 5% interest not just on the original $1,000, but also on the $50 you earned before. So you earn 5% of $1,050, which is $5,250. This keeps happening year after year, making your investment grow more quickly. The key to compound interest is time. The longer you leave your money invested, the more powerful compounding becomes. Even small amounts of money can grow into a large sum if you start early and keep it invested. For example, if you invest $1,000 every year for 30 years at a 7% interest rate, your total investment would be $30,000. But because of compound interest, your money could grow to more than $90,000. This shows how compound interest can multiply your savings many times over. Another important point is to start investing as early as possible. The earlier you begin, the more time your money has to grow through compounding. Waiting even a few years can reduce the final amount you will have. Also, be patient and avoid withdrawing your money too soon. The power of compounding works best when you keep your money invested for a long time without interruptions. In summary, compound interest is a powerful force in investing. It helps your money grow faster by earning interest on your interest. Starting early, investing regularly, and being patient are the keys to making the most of compound interest. Remember, time is your best friend when investing. The sooner you start, the more your money can grow. Use the power of compound interest to reach your financial goals faster and build long-term wealth. When people invest money, they want to make a profit. But investing always comes with two main ideas: risk and return. Return means the money you make from an investment. It can be in the form of interest, dividends, or capital gains. For example, if you buy a stock for $100 and later sell it for $110, your return is $10. Risk is the chance that you could lose money instead of making money. It means your investment may not grow, or you could lose some or all of the money you put in. Every investment has some level of risk. Usually, the higher the potential return, the higher the risk involved. This is called the risk-return trade-off. For example, savings accounts or government bonds usually have low risk. You get a small but steady return. On the other hand, stocks or real estate can have higher returns, but they come with more risk. Their prices can go up and down a lot. Investors need to understand their own comfort with risk. Some people want to keep their money very safe, even if returns are low. Others are willing to take more risk to try to get bigger profits. Diversification is one way to manage risk. It means spreading money across different investments, so if one loses value, others might do better and balance it out. To summarize, return is what you earn from your investment. Risk is the possibility of losing money. Higher returns usually mean higher risks. Knowing your risk tolerance helps you choose the right investments. Diversifying can reduce your overall risk. Understanding risk and return is key to making smart investment choices. Welcome. This video will guide you through the basics of real estate investing. If you are new to this, don't worry. We will cover the important points you need to know to get started. What is real estate investing? Real estate investing means buying property to make money. You can buy homes, apartments, land, or commercial buildings. The goal is to earn income or make a profit by selling later. Why invest in real estate? There are many reasons why people invest in real estate. It can provide steady income through rent. Property usually increases in value over time. It is a way to diversify your investments. You can use leverage, which means borrowing money to buy bigger properties. Types of real estate investments. There are different ways to invest in real estate. Rental properties. Buy a home or apartment and rent it out to tenants. This creates monthly income. Flipping houses. Buy a property, fix it up, and sell it for a higher price. Real estate investment trusts, REITs. These are companies that own real estate and you can buy shares in them, similar to stocks. Commercial properties. These include offices, shops, or warehouses which you can rent to businesses. How to start investing. Here are simple steps to start real estate investing. Learn about the market. Research the area where you want to buy. Check prices, rental demand, and neighborhood quality. Set a budget. Decide how much money you can invest, including down payment and other costs like taxes and repairs. Get financing. Talk to banks or lenders about loans. Good credit helps get better rates. Find a property. Look for properties that fit your budget and goals. Use real estate websites, agents, or auctions. Run the numbers. Calculate expected income and expenses to see if the investment makes sense. Make an offer and close. Once you find the right property, make an offer and complete the purchase. Tips for beginners. Start small with a single property. Always inspect the property carefully before buying. Know the local laws and tenant rights. Keep some money saved for unexpected costs. Consider hiring a property manager if you don't want to handle tenants. Risks to keep in mind. Real estate investing has risks. Property values can drop. Tenants may cause damage or fail to pay rent. Repairs and maintenance costs can be high. It may take time to sell a property. Always be prepared and don't invest money you can't afford to lose. Final thoughts. Real estate investing can be a powerful way to build wealth. With the right knowledge and planning, beginners can succeed. Take your time, do your research, and start small. Over time, your investments can grow and provide steady income. Retirement planning is the process of preparing financially for life after you stop working. It means setting goals, saving money, and investing wisely to ensure you have enough funds to live comfortably. Planning for retirement early is very important, and here's why. First, starting early gives your money more time to grow. When you save or invest, your money can earn interest or returns. Over time, this can increase your savings significantly. This is called compound interest. The longer your money stays invested, the more it grows, like a snowball getting bigger as it rolls. Even small amounts saved regularly can turn into a large sum if you start early. Second, retirement can last for many years, sometimes 20, 30, or even 40 years. Life expectancy has increased, so you may need more money to cover living expenses, healthcare, and emergencies. If you don't plan early, you might run out of money during retirement, which can cause stress and limit your lifestyle. Third, starting early means you can take advantage of different investment options. When you have more time before retirement, you can choose investments with higher risks and potentially higher returns. As you get closer to retirement, you can switch to safer investments. This strategy helps balance growth and security. Fourth, early retirement planning helps reduce financial pressure later in life. If you wait until you are older, you will have less time to save, which means you may need to save much more each month. This can be difficult and stressful, especially if unexpected expenses come up. Fifth, early planning allows you to take full advantage of employer-sponsored retirement plans like 401k or pension plans. Many employers match a portion of your contributions, which is like free money. Starting early ensures you don't miss out on these benefits. Finally, retirement planning is not just about money. It also helps you set clear goals for your future. You can decide when you want to retire, where you want to live, and what activities you want to enjoy. Having a plan gives you peace of mind and confidence about your future. In summary, retirement planning early on is important because it allows your money to grow, prepares you for a long retirement, gives you more investment choices, reduces future financial stress, maximizes employer benefits, and helps you set life goals. The best time to start planning for retirement is now. The sooner you start, the better your financial future will be. Planning for retirement is important to secure your financial future. Two of the most common retirement accounts in the United States are the 401k and the IRA. Both help you save money for retirement, but they work differently. Let's look at each one and understand how they can benefit you. What is a 401k? A 401k is a retirement savings plan offered by many employers. It allows you to save money directly from your paycheck before taxes are taken out. This means you pay less tax now because the money you put in is tax deferred. You do not pay taxes on this money until you withdraw it in retirement. Many employers also offer a matching contribution. For example, if you contribute 5% of your salary, your employer might add extra money to your 401k account. This is like free money that helps your savings grow faster. You can usually start withdrawing money from your 401k after age 59 and a half without penalties. If you take money out before then, you might have to pay extra taxes and penalties. What is an IRA? IRA stands for Individual Retirement Account. Unlike a 401k, you open an IRA on your own through a bank, brokerage, or financial institution. There are two main types of IRAs: traditional IRA and Roth IRA. A traditional IRA works like a 401k by letting you put in pre-tax money. This means you may get a tax deduction now and pay taxes later when you withdraw money in retirement. A Roth IRA is different. You contribute money that you have already paid taxes on. The benefit is that when you withdraw money in retirement, it is tax-free. You pay taxes now but not later. Contribution limits. Both accounts have limits on how much money you can contribute each year. For 2024, the 401k contribution limit is $2,500. If you are 50 or older, you can add an extra $7,500 as a catch-up contribution. For IRAs, the yearly contribution limit is $6,500 with an additional $1,000 catch-up if you are 50 or older. Which one should you choose? If your employer offers a 401k with matching contributions, it is usually a good idea to contribute enough to get the full match. After that, you can consider opening an IRA to save more. If you want tax-free income in retirement, a Roth IRA might be the best choice. But if you want to reduce your taxable income now, a traditional IRA or 401k can help. Summary: both 401k and IRA accounts are excellent tools to save for retirement. A 401k is offered through your employer, with possible matching contributions and tax deferral. An IRA is opened individually, with options for traditional tax-deferred savings or Roth tax-free savings. Start saving early, understand your options, and choose the account that fits your financial goals. Investing can be a great way to grow your money over time, but it also comes with risks. One of the best ways to manage those risks is through diversification. Diversification means spreading your investments across different types of assets. This helps protect your money if one investment does poorly. Think of it like not putting all your eggs in one basket. If one basket drops and breaks, you still have other eggs safe in different baskets. There are several ways to diversify your portfolio. First, invest in different asset classes. These include stocks, bonds, real estate, and cash or cash equivalents. Stocks can offer high returns but come with higher risk. Bonds are generally safer but with lower returns. Real estate provides a different type of investment that can generate rental income or appreciate in value. Cash or equivalents are the safest but usually offer the lowest returns. Second, diversify within each asset class. For example, don't buy just one company's stock. Instead, buy shares in many companies across different industries. This reduces the risk of losing money if one company or sector struggles. Third, consider investing in different geographic regions. Don't limit yourself to your home country. Global markets can offer growth opportunities and reduce risk from local economic problems. Diversification also includes investment styles. Some investors prefer growth stocks, which aim for rapid price increases. Others prefer value stocks, which are often undervalued and may provide steady income. One important tool for diversification is mutual funds or exchange-traded funds, also called ETFs. These funds pool money from many investors to buy a variety of assets. Buying shares in a mutual fund or ETF allows you to invest in a wide range of assets without buying each one separately. Diversification helps smooth out the ups and downs of the market. While some investments may fall in value, others may rise. This balance helps protect your portfolio and improve long-term returns. However, diversification does not eliminate all risk. It can reduce risk, but investments can still lose value. That is why it is important to review and adjust your portfolio regularly based on your goals and risk tolerance. To summarize, diversify across asset classes like stocks, bonds, real estate, and cash. Diversify within asset classes by investing in different companies and sectors. Diversify geographically by investing globally. Use mutual funds and ETFs to gain instant diversification. Regularly review your portfolio to keep it balanced. By diversifying your investment portfolio, you take steps to protect your money and build wealth steadily over time. It is a smart strategy for any investor. Saving money for big purchases like a car, a house, or education can seem difficult. But with a good plan and patience, anyone can do it. Here are simple steps to help you save effectively. Set a clear goal first. Decide exactly what you want to buy. Is it a car, a house, or paying for school? Next, find out how much it will cost. Do some research online or ask experts. Write down the total amount you need to save. Make a saving plan. Once you know the total cost, break it down into smaller parts. For example, if you want to buy a car that costs $10,000 and you want to buy it in 2 years, you need to save about $417 every month. Setting a monthly saving target makes your goal easier to reach. Open a separate savings account. Keep your savings safe by opening a separate account just for your big purchase. This way, you won't spend the money accidentally. Look for an account that gives good interest. This helps your money grow a little while you save. Cut unnecessary expenses. Look at your daily spending and find things you can reduce or stop. Maybe eat out less or cancel unused subscriptions. Use that extra money to add to your savings. Even small amounts add up over time. Increase your income. Try to find ways to earn more money. You can take extra work, sell things you don't need, or use your skills for freelancing. More income means you can save faster. Stay patient and consistent. Saving for big purchases takes time. Don't get discouraged if progress seems slow. Keep saving regularly every month. Remember, small steps lead to big results. Avoid debt if possible. Saving for big purchases, progress seems slow. Saving regularly. Small steps. Try not to use credit cards or loans for these purchases unless necessary. Debt means you pay extra money as interest. Saving and paying cash is better for your financial health. Review and adjust your plan. Every few months, check your savings progress. If you are behind, try to save a little more. If you are ahead, you can relax or even buy your items sooner. By following these steps, saving for a car, a house, or education becomes easier. Remember, success depends on your dedication and smart money habits. Start today and you will reach your big goal. Living expenses can add up quickly, but cutting costs doesn't mean you have to give up the lifestyle you enjoy. Today we will explore simple and effective ways to reduce your expenses while still living comfortably. Track your spending. The first step to saving money is knowing where it goes. Start by tracking your daily expenses for a week or two. Use a notebook, an app, or a spreadsheet. When you see your spending habits clearly, it becomes easier to find areas where you can cut back without feeling the pinch. Cook more at home. Eating out often is expensive. Cooking at home saves money and is usually healthier. Try planning your meals for the week, making a shopping list, and buying only what you need. Batch cooking can also save time and money by preparing several meals at once. Use energy wisely. Energy bills can be a big part of your expenses. Simple changes can reduce these costs. Turn off lights and electronics when not in use. Use energy-efficient bulbs. Adjust your thermostat a few degrees to save on heating or cooling without sacrificing comfort. Shop smart. Look for discounts, coupons, and sales when shopping for groceries and essentials. Buy in bulk for items you use often, but only if you can store them properly. Avoid impulse buys by making a list before you shop and sticking to it. Cut subscriptions. You don't use. Many people pay for subscriptions they rarely use. Review all your subscriptions like streaming services, magazines, or apps. Cancel the ones you don't need or share accounts with family or friends to split the cost. Use public transport or carpool. If you own a car, consider using public transport, biking or walking for short trips. Carpooling with co-workers or neighbors can also reduce fuel and parking costs. This saves money and is better for the environment. Choose affordable entertainment. You don't need to spend a lot on entertainment. Explore free or low-cost activities like visiting parks, community events, or libraries. Try hobbies that don't require expensive equipment or memberships. Maintain your belongings. Taking care of your things helps avoid costly repairs or replacements. Regularly clean and maintain your appliances, clothes, and car. This extends their life and keeps you from spending unnecessarily. Avoid debt and payoff. High-interest loans. Debt can increase your expenses through interest payments. Avoid taking on new debt when possible. If you have high-interest loans, focus on paying them off quickly to save money in the long run. 10. Set savings goals. Finally, set clear savings goals to stay motivated. Even small amounts saved regularly add up over time. Having goals helps you focus on what matters and avoid unnecessary spending. Reducing expenses doesn't have to mean sacrificing your lifestyle. With simple, smart choices, you can save money and still enjoy life. Start today and watch your savings grow without losing the things you love. Financial independence and early retirement, or the FIRE movement, is a lifestyle and financial strategy focused on gaining freedom from traditional work early in life. The goal is to save and invest enough money to live comfortably without relying on a regular paycheck. The idea behind FIRE is simple. Spend less than you earn, save aggressively, and invest wisely. By doing this, you can build a large enough savings pool to cover your living expenses indefinitely. There are 4 main steps in the FIRE journey. Track your expenses. Understanding where your money goes is the first step. Keep track of everything you spend to find areas where you can cut back. This helps increase your savings rate. Increase your savings rate. People in the FIRE movement often aim to save 50% or more of their income. This means living well below their means, cutting unnecessary expenses, and focusing on essentials. Invest your savings. Saving alone is not enough. To grow your wealth faster, invest in assets like stocks, bonds, real estate, or retirement accounts. Over time, compound interest helps your money grow exponentially. Calculate your FIRE number. Your FIRE number is the amount of money you need to retire early. It depends on your annual expenses and the safe withdrawal rate, which is usually around 4%. For example, if you spend $40,000 a year, your FIRE number is about $1 million. This means you need $1 million invested to generate enough income to cover your expenses without running out of money. The benefits of the FIRE movement include freedom and flexibility. Once financially independent, you can choose how to spend your time. Some people travel, start new projects, volunteer, or pursue hobbies without worrying about money. However, FIRE is not for everyone. It requires discipline, patience, and sometimes sacrifices. Living on a tight budget and delaying gratification can be challenging. It also means planning carefully for health insurance, emergencies, and unexpected expenses. In summary, the FIRE movement offers a way to take control of your finances and life by focusing on saving, investing, and smart spending. With clear goals and steady progress, financial independence and early retirement are possible for many people. Saving money and investing regularly can help you build wealth over time. One of the easiest ways to do this is by setting up automatic savings and investments. This video will guide you step by step on how to do it. Step 1. Choose your savings and investment accounts. First, decide where you want to save and invest your money. For savings, you can use a savings account at your bank or an online savings account with higher interest rates. For investments, consider opening an investment account. This could be a brokerage account, a retirement account like an IRA, or an investment app on your phone. Make sure the account fits your goals and risk level. Step 2. Link your bank account. Next, link your main bank account to your savings or investment account. This allows money to move automatically between accounts without you having to do anything manually. Most banks and investment platforms make this easy through their website or mobile app. Just follow the instructions to connect your accounts securely. Step 3. Decide how much to save or invest. Now choose how much money you want to transfer automatically. Start with an amount that fits your budget. It could be $50, $100, or any amount you feel comfortable with. Remember, even small amounts add up over time. You can increase this amount later as your finances improve. Step 4. Set up automatic transfers. After deciding the amount, set up automatic transfers or contributions. This means money will move from your bank account to your savings or investment account regularly, such as every week or every month. On your bank or investment app, find the option for automatic transfers or recurring contributions. Select the amount and the frequency, then confirm. Step 5. Review and adjust regularly. Once set up, check your accounts regularly to make sure everything is working correctly. Over time, you might want to increase your savings or investment amount. Also, review your investment choices occasionally to make sure they still match your goals. Benefits of automatic savings and investments. Automatic transfers help you stay consistent without thinking about it. This builds good financial habits and helps your money grow with time. You avoid the temptation to spend money meant for savings, and you make investing easier by contributing regularly. Final tips. Start small and be consistent. Use apps or platforms that you trust and have good reviews. Keep track of your progress to stay motivated. Setting up automatic savings and investments is a simple but powerful step to reach your financial goals. That's it. Now you know how to set up automatic savings and investments to grow your money without stress. Managing money together is important for a healthy and happy relationship. When two people share their lives, their finances also become connected. This can be a source of strength but also challenges. Here are some simple tips to help manage finances in a relationship. First, talk openly about money. It is important to be honest about your income, debts, spending habits, and financial goals. Many problems happen because partners avoid this conversation. Set aside time to discuss your finances regularly. Second, create a budget together. Decide how much money will go to bills, groceries, savings, and fun activities. A shared budget helps avoid confusion and arguments. You can use an app or just write it down. The key is to agree on it and follow it. Third, decide how to handle accounts. Some couples choose to have joint bank accounts while others keep separate accounts and share certain expenses. There is no right or wrong way. The best choice depends on what works for both of you. Fourth, set financial goals as a team. These goals could be paying off debt, saving for a home, or planning a vacation. When you work toward goals together, it builds trust and a sense of partnership. Fifth, respect each other's spending habits. It's okay to have different views on money, but respect is important. Avoid blaming or controlling each other's choices. Instead, try to understand and find compromises. Finally, prepare for emergencies. Set up an emergency fund for unexpected expenses like medical bills or car repairs. Having this safety net reduces stress and helps keep your relationship strong. In summary, managing finances in a relationship requires clear communication, planning, and respect. By working together, you can build a secure financial future and a stronger bond. Insurance is a way to protect yourself from financial loss. It helps cover costs if something unexpected happens. There are many types of insurance, but 4 common ones are health, life, auto, and property insurance. Each one serves a different purpose. Health insurance. Health insurance helps pay for medical expenses. This includes doctor visits, hospital stays, medicines, and sometimes even dental and vision care. When you have health insurance, you usually pay a monthly fee called a premium. In return, the insurance company covers part of your medical bills. There are different plans with different costs and benefits. Some plans require you to pay a portion of the bill, called a deductible, before insurance helps. Other plans may cover most costs after the premium is paid. Health insurance protects you from very high medical bills if you get sick or injured. Life insurance. Life insurance provides money to your family or dependents after you pass away. It gives financial support to cover expenses like funeral costs, debts, or living expenses. There are 2 main types, term life and whole life insurance. Term life insurance covers you for a specific time, like 10 or 20 years. If you die during that time, your family gets the money. Whole life insurance lasts your whole life and can also build cash value over time. Life insurance is important for anyone who has people depending on their income. Auto insurance. Auto insurance protects you from costs related to car accidents. It covers damage to your vehicle, damage to others' property, and medical expenses if someone is hurt. Auto insurance is required by law in most places. There are different parts of auto insurance: liability, collision, and comprehensive. Liability pays for damage or injury you cause to others. Collision pays for damage to your car in an accident. Comprehensive covers other damage like theft, fire, or natural disasters. Having auto insurance helps you avoid large repair bills and legal trouble. Property insurance protects your home and belongings. It covers damage caused by fire, theft, storms, or other unexpected events. If your house or things inside are damaged, property insurance helps pay for repairs or replacements. Homeowners insurance is the most common property insurance. Renters can also buy renter's insurance to protect their personal belongings. Property insurance gives peace of mind by protecting your valuable assets. Why insurance is important. Life is full of uncertainties. Insurance helps reduce financial risk by sharing the cost with others. Instead of paying thousands of dollars in an emergency, you pay smaller regular amounts called premiums. Insurance helps you stay financially stable and protects your family. Choosing the right insurance depends on your needs, budget, and risks. It is important to understand what each insurance covers and how much it costs. Always read the policy carefully before buying. Building and maintaining an investment portfolio is one of the best ways to grow your wealth over time. Whether you are just starting or want to improve your existing portfolio, this guide will help you understand the basic steps. Step 1. Understand your financial goals. Before you start investing, think about your financial goals. Are you saving for retirement, buying a house, or creating an emergency fund? Knowing your goals helps you decide how much risk you can take and what kind of investments to choose. Step 2. Learn about different types of investments. There are many types of investments like stocks, bonds, mutual funds, and real estate. Stocks can offer higher returns but come with higher risk. Bonds are generally safer but give lower returns. Mutual funds let you invest in many stocks or bonds at once, spreading out your risk. Step 3. Decide on your asset allocation. Asset allocation means how you divide your money among different types of investments. A balanced portfolio usually has a mix of stocks, bonds, and sometimes cash. Younger investors might choose more stocks for growth, while older investors may prefer more bonds for stability. Step 4. Start investing regularly. Once you decide your asset allocation, start investing regularly. This is called dollar-cost averaging. By investing a fixed amount every month, you buy more shares when prices are low and fewer shares when prices are high. This strategy helps reduce risk. Step 5. Monitor your portfolio. Keep an eye on your portfolio to see how your investments are doing. You don't need to check every day, but review it every few months. If some investments grow faster than others, your portfolio may become unbalanced. Step 6. Rebalance your portfolio. Rebalancing means adjusting your investments back to your original asset allocation. For example, if stocks have grown and now make up 70% of your portfolio but you want 60%, you sell some stocks and buy bonds or cash to restore balance. Rebalancing helps keep your risk in check. Step 7. Keep learning and stay patient. Investing is a long-term process. Markets go up and down, but staying patient and disciplined usually pays off. Keep learning about investing and adjust your strategy as your financial goals change. That's how you build and maintain a strong investment portfolio. Start early, stay consistent, and keep your goals clear. Your future self will thank you. Credit cards are a useful financial tool when used carefully. They help you buy things now and pay later. But if not managed well, they can lead to big debt problems. Today, you will learn how to use credit cards wisely and avoid falling into debt. First, always spend only what you can afford to pay back. Treat your credit card like cash, not free money. Before buying something, ask yourself, can I pay this amount in full when my bill arrives? If the answer is no, don't buy it with a credit card. Second, pay your credit card bill in full every month. Avoid making only the minimum payment. Paying the minimum keeps your debt and interest growing. When you pay the full balance, you avoid interest charges and save money. Third, keep track of your spending. Many credit cards offer apps or online accounts where you can check your purchases anytime. Use these tools to stay aware of how much you are spending. This helps prevent surprises when the bill comes. Fourth, avoid cash advances on your credit card. Cash advances usually come with high fees and higher interest rates. Only use them in emergencies and try to pay them off as soon as possible. Fifth, choose a credit card with a low interest rate and no or low annual fees. If you have a good credit score, you can get better credit card offers with lower costs. Always read the terms and conditions before applying. Sixth, don't apply for too many credit cards at once. Each application can lower your credit score temporarily. Having too many cards can also make it harder to manage payments. Finally, if you ever feel overwhelmed by credit card debt, seek help early. Talk to a credit counselor or financial advisor who can guide you to manage your debt better. To summarize, use your credit card responsibly by spending only what you can pay back, paying the full bill each month, tracking your expenses, avoiding cash advances, choosing the right card, and managing the number of cards you have. Using credit cards wisely can improve your credit score and give you financial flexibility without causing debt problems. Follow these simple steps to stay in control of your money and avoid debt. Financial statements are essential documents that provide a clear picture of a company's financial health. They help investors, managers, and other stakeholders make informed decisions. There are three main types of financial statements: the balance sheet, the income statement, and the cash flow statement. Each one shows different information about the company's finances. First, the balance sheet shows what a company owns and owes at a specific point in time. It is divided into three parts: assets, liabilities, and equity. Assets are everything the company owns, like cash, inventory, and property. Liabilities are the company's debts or obligations, such as loans or bills to pay. Equity represents the owner's share in the company, which is what remains after subtracting liabilities from assets. The balance sheet follows the formula: assets equal liabilities plus equity. Next, the income statement summarizes the company's revenues and expenses over a period of time, usually a quarter or a year. It shows how much money the company earned and how much it spent to operate. The key figure in the income statement is the net income, which is the profit or loss after all expenses are deducted from total revenue. A positive net income means the company made a profit, while a negative net income indicates a loss. The third important financial statement is the cash flow statement. This report shows how cash moves in and out of the company during a specific period. It is divided into three categories: operating activities, investing activities, and financing activities. Operating activities include cash earned or spent from the company's core business. Investing activities show cash used for buying or selling assets like equipment or investments. Financing activities cover cash received from or paid to investors and lenders, such as issuing shares or repaying loans. The cash flow statement helps users understand if the company has enough cash to run its daily operations and pay its bills. In addition to these main statements, companies often provide notes and additional reports. These notes explain details behind the numbers, accounting methods used, and any important changes or risks. Reading these notes can give a deeper understanding of the company's financial condition. Understanding financial statements is important for many reasons. Investors use them to decide if they want to buy or sell stock. Managers rely on them to plan and control business activities. Creditors check these statements to assess if a company can repay loans. Overall, financial statements provide transparency and build trust between a company and its stakeholders. In summary, the balance sheet shows what a company owns and owes. The income statement reveals profitability, and the cash flow statement tracks cash movement. Together, they form a complete financial picture that is crucial for making smart financial decisions. Managing money well is very important for a secure future. Improving your financial habits can help you save more, spend wisely, and reduce stress about money. Here are some easy steps to improve your financial habits starting today. Step 1. Track your spending. The first step is to know where your money goes. Write down every expense you have for 1 month. Include small things like coffee or snacks. This helps you see which expenses are necessary and which ones you can reduce or eliminate. Step 2. Create a budget. After tracking your expenses, make a budget. A budget is a plan for your money. List your income and all your expenses. Divide your money into categories like rent, food, transportation, savings, and entertainment. Stick to your budget and adjust it if needed. Step 3. Save regularly. Saving money is very important. Try to save at least 10% of your income every month. You can start small and increase the amount over time. Put your savings in a separate account that is not easy to access, so you don't spend it by mistake. Step 4. Avoid unnecessary debt. Try not to borrow money for things you don't really need. Credit cards and loans can be helpful, but can also lead to problems if you don't manage them well. Pay your credit card bills on time to avoid interest and extra charges. Step 5. Set financial goals. Having clear goals motivates you to save and manage money better. Your goals can be short-term, like saving for a vacation, or long-term, like buying a house or retirement. Write your goals down and review them regularly. Step 6. Educate yourself. Learn about money management. Read books, watch videos, or take free online courses about personal finance. The more you know, the better decisions you can make about your money. Step 7. Review and adjust every month. Review your budget and spending. See what worked and what didn't. Adjust your budget and goals as your income or expenses change. Improving financial habits is a continuous process. Summary. To improve your financial habits, track your spending, create a budget, save regularly, avoid unnecessary debt, set clear financial goals, educate yourself, and review your progress often. These simple steps can help you build a strong financial future. Start today and take control of your money for a better tomorrow. Student loans can feel overwhelming, but there are smart ways to pay them off faster and save money on interest. Here are some effective tips to help manage and reduce your student debt. Know your loans. Start by understanding your loans. Write down the total amount you owe, the interest rates, and the monthly payments. Knowing these details helps you create a plan. Make more than the minimum payment. If possible, pay more than the minimum amount each month. Even a little extra money can reduce your loan balance faster and lower the total interest you pay. Pay on time. Every month. Always make your payments on time. Missing payments can cause late fees and hurt your credit score. Setting up automatic payments can help you avoid missing due dates. Focus on high-interest loans first. If you have multiple loans, try to pay off the ones with the highest interest rates first. This approach, called the avalanche method, saves you money over time. Use windfalls and bonuses. Any extra money you get, like tax refunds, work bonuses, or gifts, can go towards your student loans. This helps you pay down the debt faster. Refinance your loans. Refinancing means getting a new loan with a lower interest rate to replace your current loans. This can lower your monthly payments and save interest, but check if you will lose any benefits from your original loans. Consider income-driven repayment plans. If your income is low, income-driven repayment plans adjust your monthly payments based on how much you earn. This can make payments more affordable while you work to pay off your debt. Avoid new debt. Try not to add more debt while paying off your student loans. Limit credit card use and avoid taking out additional loans if possible. Stay motivated. Paying off student loans takes time and patience. Celebrate small wins and track your progress. Every payment gets you closer to being debt-free. Summary. Know your loans and interest rates. Pay more than the minimum when you can. Always pay on time. Focus on high-interest loans first. Use extra money to reduce debt faster. Consider refinancing for better rates. Explore income-driven plans if needed. Avoid new debt during repayment. Stay motivated and track progress. Following these smart steps helps you take control of your student loans and move closer to financial freedom. Start today and your future self will thank you. Unexpected expenses happen to everyone. Whether it's a car repair, medical bill, or home emergency, these costs can disrupt your budget if you are not prepared. Planning for these surprises helps you stay calm and in control of your finances. Step 1. Understand what unexpected expenses are. Unexpected expenses are costs you did not plan for. Examples include car breakdown or repairs, medical emergencies, household repairs like plumbing or electrical issues, sudden travel needs. Knowing these can happen helps you accept that emergencies are normal and need preparation. Step 2. Build an emergency fund. The best way to prepare is by saving money regularly. This is called an emergency fund. Aim to save at least 3 to 6 months' worth of your essential living expenses. This fund is only for true emergencies, not for everyday spending. Start small if you need to. Even saving a little bit each month is better than nothing. Over time, your emergency fund will grow and give you peace of mind. Step 3. Track your spending. Keep track of your income and expenses every month. When you know where your money goes, you can find ways to save more. Use a notebook, an app, or a spreadsheet, whatever works best for you. Tracking helps you see unnecessary spending and frees up money to add to your emergency fund. Step 4. Cut non-essential expenses. Look for areas where you can reduce spending. For example, limit eating out or ordering takeout. Cancel unused subscriptions. Buy only what you need. Putting this saved money into your emergency fund prepares you for unexpected costs. Step 5. Use insurance wisely. Insurance protects you from very large expenses. Health, auto, home, and renter's insurance can reduce the financial damage of emergencies. Make sure you have the right coverage for your situation. Review your insurance policies yearly to ensure they meet your current needs. Step 6. Plan for smaller, unexpected costs. Not all surprises are big. For small expenses, keep a separate buffer amount in your checking account. This could be $100 to $200 set aside for minor unexpected purchases. Step 7. Avoid debt when possible. Try not to rely on credit cards or loans for emergencies. Debt adds interest and stress. Using your emergency fund instead helps you avoid paying extra money over time. Summary: unexpected expenses are normal. Save money regularly for an emergency fund. Track your spending and cut unnecessary costs. Use insurance to protect yourself. Keep a small buffer for minor surprises. Avoid debt whenever possible. By planning ahead, you can handle unexpected expenses with confidence and keep your financial life stable. Money is more than just numbers. It is connected deeply to how we think and feel. Our mindset about money shapes our decisions every day. Understanding this can help us spend smarter and save better. First, let's talk about mindset. Mindset means how you think about something. When it comes to money, some people have a scarcity mindset. This means they believe there is never enough money. They worry about running out, so they may hold on too tightly or avoid spending it all. Others have an abundance mindset. They believe there is enough money to go around. They feel confident to spend and invest wisely. Your mindset affects your spending habits. If you feel afraid or anxious about money, you might spend impulsively to feel better. This is called emotional spending. For example, buying things you don't need just to feel happy for a short time. But this can cause stress later when bills come due. On the other hand, if you feel secure about your money, you are more likely to plan and budget. You think about your goals and make choices that support your future. This means saving for emergencies, investing for growth, and avoiding debt when possible. Our brains are wired to seek rewards. Spending money can release dopamine, a chemical that makes us feel good. This is why shopping can feel like a quick fix. But it's important to balance this feeling with long-term thinking. Ask yourself before buying, do I really need this? Will this help me reach my goals? Another important idea is financial self-awareness. This means knowing your habits, emotions, and beliefs about money. When you understand why you spend a certain way, you can change for the better. For example, if you notice you spend more when stressed, find other ways to relax, like walking or talking to a friend. Finally, mindset can be changed. It is not fixed. You can train yourself to think differently about money. Practice gratitude for what you have. Set clear financial goals. Celebrate small wins when you save or pay off debt. Over time, your mindset will grow stronger and healthier. In summary, the psychology of money shows us that how we think about money controls how we use it. Changing your mindset can help you spend smarter, save more, and feel more secure. Start today by paying attention to your thoughts and habits. Your future self will thank you. Saving money for your child's education is very important. College and other education costs are rising every year. Starting early and having a good plan can make it easier and less stressful. Here are some easy steps to help you save effectively. Step 1. Set a clear goal first. Decide how much money you need to save. Research the average cost of the education you want for your child. Think about tuition, books, housing, and other fees. This will give you a target amount to work toward. Step 2. Start saving early. The sooner you start saving, the better. Even small amounts add up over time because of interest. If you start when your child is very young, you can take advantage of compound interest, which helps your money grow faster. Step 3. Choose the right savings option. There are different ways to save money for education. Some popular options include education savings accounts. These are special accounts where your money can grow tax-free if used for education. 529 plans. These are state-sponsored plans designed for education savings with tax benefits. Regular savings account. If you want easy access to money, a regular savings account is a good option, but the interest might be lower. Investments. Stocks, mutual funds, or bonds can give higher returns but come with some risk. Choose what fits your comfort level. Step 4. Make saving a habit. Try to save regularly every month. Set up automatic transfers from your paycheck or bank account into the savings plan. Consistency is key to building a good fund over time. Step 5. Look for scholarships and grants. Even with good savings, look for scholarships and grants when your child applies for college. These don't need to be paid back and can reduce the total cost. Step 6. Keep track and review your savings plan once a year. If costs increase or your income changes, adjust your monthly savings amount. Staying flexible helps you stay on track. Step 7. Teach your child about money. It's also helpful to teach your child about saving and budgeting. This prepares them to manage money wisely during their education. Conclusion. Saving for your child's education takes time and discipline, but starting early and planning well can make it easier. Use the right savings tools, save regularly, and keep your goal in mind. This way, you can give your child the gift of a good education without financial stress. Saving money on your utility bills is easier than you think. By making small changes at home, you can reduce your energy and water use and see real savings every month. Here are some simple tips to help you get started. Turn off lights and appliances when not in use. Make sure to switch off lights when you leave a room. Unplug devices like phone chargers, TVs, and computers if you are not using them. Even when turned off, some electronics still use power if they remain plugged in. This is called phantom energy, and it adds up over time. Use energy-efficient light bulbs. Replace old incandescent bulbs with LED or CFL bulbs. These use much less electricity and last longer. Although they cost a bit more up front, they save you money in the long run. Adjust your thermostat. In cold weather, lower your heating temperature by a few degrees. In hot weather, raise the air conditioning temperature a little. Even a small change can reduce your energy bill significantly. Using a programmable thermostat helps by adjusting the temperature automatically when you are not home. Fix leaks and drips. A leaking faucet or running toilet wastes water and increases your water bill. Check all taps and pipes for leaks. Fixing these problems quickly can save you a lot of money. Take shorter showers and use less hot water. Hot water uses energy to heat, so reducing shower time and using cooler water can lower your bills. Consider installing low-flow shower heads to save water without sacrificing comfort. Use appliances wisely. Run your dishwasher and washing machine only when they are full. Use cold water for laundry whenever possible. Dry clothes outside in the sun instead of using a dryer. Seal windows and doors. Gaps and cracks let warm or cool air escape, making your heating and cooling systems work harder. Use weather stripping or caulk to seal these leaks and keep your home comfortable. Use fans and natural ventilation. In warm weather, use ceiling or portable fans to circulate air. Open windows to create a breeze instead of using the air conditioner all the time. Monitor your energy use. Keep track of your utility bills to see how much energy and water you use each month. This helps you understand where you can improve and saves you money in the future. By following these easy steps, you can lower your utility bills without sacrificing comfort. Saving energy and water is good for your wallet and the environment. Start today and watch your savings grow. Planning for retirement is important to make sure you can enjoy your later years without money worries. Here's a simple step-by-step guide to help you prepare financially for retirement. Step 1. Set your retirement goals. First, think about when you want to retire. Do you want to stop working at 60, 65, or later? Also, consider how you want to live after retirement. Do you want to travel, live comfortably, or help your family? Knowing your goals will help you figure out how much money you need. Step 2. Calculate your retirement needs. Next, calculate how much money you will need every year in retirement. Include costs like housing, food, healthcare, travel, and entertainment. Remember, some costs might go down, but healthcare usually goes up. Multiply your yearly needs by the number of years you expect to live after retirement to get a total amount. Step 3. Review your current savings and income sources. Look at the money you already have saved, like in a pension, 401k, or other retirement accounts. Also include any other income sources you will have in retirement, such as Social Security or rental income. This helps you see how much more you need to save. Step 4. Create a savings plan. Based on your retirement goals and the money you need, create a savings plan. Decide how much money to save each month or year. If you start early, you can save smaller amounts thanks to compound interest, which means your money grows over time. Step 5. Invest wisely. Put your savings into investments that match your risk tolerance and time frame. When you are younger, you can take more risks with stocks or mutual funds. As you get closer to retirement, shift to safer investments like bonds or fixed deposits. Step 6. Monitor and adjust your plan. Life changes, and so do financial markets. Check your retirement plan at least once a year. Make changes if needed. If your savings are not growing as planned, try to save more or adjust your retirement age or lifestyle goals. Step 7. Plan for healthcare and emergencies. Healthcare costs can be high during retirement. Make sure you have health insurance or savings for medical expenses. Also, keep an emergency fund separate from your retirement savings to cover unexpected costs. Step 8. Prepare for retirement income withdrawal. When you retire, decide how to withdraw money from your accounts. Try to make your money last by withdrawing a reasonable amount each year, usually around 4% of your savings. Plan your withdrawals to reduce taxes and avoid running out of money. Managing money wisely is important for a secure and stress-free life. Many people make mistakes with their finances that cause problems later. In this video, you will learn how to avoid some common financial pitfalls and keep your money safe. Create and stick to a budget. One of the biggest mistakes is not having a budget. A budget helps you see how much money you earn and how much you spend. It shows where your money goes. Without a budget, you might spend more than you earn. To avoid this, write down your income and all your expenses. Make sure your expenses are less than your income. Track your spending every month and adjust your budget if needed. This simple step helps you control your money better. Avoid high-interest debt. Credit cards and loans can be helpful, but they can also cause big problems if not used carefully. High-interest debt grows quickly and can be hard to pay off. Try not to use credit cards for things you cannot pay off immediately. If you have loans or credit card debt, focus on paying them off as soon as possible. Avoid borrowing more money just to pay old debts. This will save you money and interest and keep you out of a debt trap. Save for emergencies. Unexpected expenses can happen anytime. Without savings, you might need to borrow money or use credit cards, which causes more problems. Build an emergency fund with at least 3 to 6 months' worth of living expenses. Start small if you need to and add to your savings regularly. Having this safety net gives you peace of mind and protects you from financial emergencies. Spend wisely. Impulse buying and spending on things you do not need can drain your money quickly. Before buying something, ask yourself if it is necessary and if you can afford it. Make a list before shopping and stick to it. Look for discounts or cheaper alternatives. Avoid buying things just because they are on sale if you don't really need them. Small savings add up over time. Plan for the future. Thinking about the future is important. Save money for retirement, education, or big goals like buying a house. Start saving early even if it is a small amount. The earlier you save, the more your money grows because of interest. Use simple savings accounts or retirement plans. Planning ahead helps you avoid financial problems later in life. Summary. To avoid common financial pitfalls, make and follow a budget. Avoid high-interest debt. Save for emergencies. Spend carefully. Plan for the future. By following these simple steps, you can build a strong financial foundation and avoid stress about money. Start today and take control of your finances for a better tomorrow. Creating a long-term financial plan is one of the smartest steps you can take to secure your financial future. It helps you set goals, manage your money wisely, and prepare for unexpected events. Here are the simple steps to build your own long-term financial plan. Step 1. Set clear financial goals. Start by deciding what you want to achieve with your money in the next 5, 10, or even 20 years. Your goals can include buying a home, saving for retirement, starting a business, or funding your children's education. Write down these goals and be specific about the amount of money you will need and the time frame. Step 2. Understand your current financial situation. Next, take a close look at your income, expenses, debts, and savings. List all sources of income, monthly bills, loans, and how much you have saved so far. This gives you a clear picture of where you stand financially. Step 3. Create a budget. A budget helps you control your spending and increase your savings. Track your expenses and compare them with your income. Cut down on unnecessary costs and set aside a fixed amount each month for your long-term goals. Step 4. Build an emergency fund. Life is full of surprises. Having an emergency fund can protect you from sudden expenses like medical bills or job loss. Aim to save at least 3 to 6 months' worth of living expenses in a separate, easily accessible account. Step 5. Plan your investments. To grow your wealth over time, invest your money wisely. Research different investment options like stocks, bonds, mutual funds, or real estate. Choose investments that match your risk tolerance and financial goals. Remember, long-term investing usually benefits from patience and consistency. Step 6. Manage debt. Wisely. Not all debt is bad, but high-interest debt can stop you from reaching your goals. Focus on paying off expensive debts first, such as credit card balances. Avoid taking new debts unless necessary and always make payments on time. Step 7. Review and adjust your plan regularly. Your financial situation and goals may change over time. Review your financial plan at least once a year. Adjust your goals, budget, and investments to stay on track and respond to life changes like a new job, marriage, or having children. Step 8. Seek professional advice if needed. If you feel overwhelmed, consider consulting a financial advisor. They can provide personalized guidance and help you create a plan suited to your needs. Summary. To create a long-term financial plan, set clear goals, understand your finances, budget carefully, build an emergency fund, invest smartly, manage debt, and review your plan regularly. This disciplined approach will help you achieve financial security and peace of mind. Investing in real assets is a popular way to protect wealth and diversify a portfolio. Real assets include physical items like gold, precious metals, real estate, and other tangible goods. Unlike stocks or bonds, these assets have intrinsic value because they exist in physical form. One of the most well-known real assets is gold. Gold has been used as a store of value for thousands of years. It is often considered a safe haven during times of economic uncertainty or inflation. When paper currencies lose value, gold usually holds its worth or even increases in price. Investors buy gold in different forms such as coins, bars, or gold-backed exchange-traded funds, often abbreviated as ETFs. Precious metals like silver, platinum, and palladium are also popular real assets. Silver is more affordable than gold and has many industrial uses which can affect its price differently. Platinum and palladium are rarer metals used in automotive and technology industries. These metals can offer diversification benefits in an investment portfolio because their prices may move differently compared to traditional stocks and bonds. Investing in real assets has some advantages. They can act as a hedge against inflation because their value tends to rise when the cost of living increases. Real assets are also less likely to be affected by stock market crashes, making them useful during financial downturns. However, there are some challenges. Physical assets require secure storage and insurance. Buying and selling can involve higher transaction costs compared to stocks or bonds. Prices can also be volatile, influenced by factors such as supply, demand, geopolitical events, and changes in currency values. Besides metals, other real assets include real estate, farmland, and commodities like oil and natural gas. Real estate investments provide rental income and potential price appreciation. Farmland is a long-term investment that benefits from increasing food demand. Commodities can be more speculative but add diversity to a portfolio. In summary, investing in real assets like gold and precious metals is a way to diversify, protect wealth, and hedge against inflation. It is important to understand the risks and costs involved. Combining real assets with traditional investments can create a balanced portfolio suited to your financial goals. Building wealth takes time and patience. It is not about getting rich quickly, but making smart choices consistently. Here are important principles to follow if you want to grow your money step by step. 1. Start early and be consistent. The earlier you start saving and investing, the better. Even small amounts add up over time because of something called compound interest. This means your money earns interest and then you earn interest on the interest. Try to save regularly, even if it is a small amount every month. Spend less than you earn. This is one of the most important rules. If you spend all your money, you cannot save or invest. Track your income and expenses. Cut unnecessary spending and focus on needs, not wants. Living below your means helps you save more money for the future. Create multiple sources of income. Relying on only one income source can be risky. Try to create more than one way to earn money. This could be a side job, a small business, or passive income like investments or rental properties. Multiple income streams help you grow wealth faster and reduce financial risk. Invest wisely. Keeping money in a savings account is safe but may not grow enough to beat inflation. Learn about different investment options like stocks, bonds, mutual funds, or real estate. Investing involves risk, but spreading your money in different places can reduce risk and increase chances of growth. Keep learning about money. Financial knowledge is powerful. Read books, watch videos, or take courses about saving, investing, and money management. The more you understand, the better decisions you can make with your money. Be patient and avoid get-rich-quick schemes. Building wealth takes time. Avoid schemes or offers that promise fast money with little effort. These are often risky and can cause you to lose money. Stay focused on long-term goals and keep following good financial habits. Protect your wealth. Once you start building wealth, protect it. Have insurance for health, property, and life to avoid big unexpected expenses. Also, plan for taxes and legal matters so your wealth stays safe for you and your family. Summary: start saving early, spend less than you earn, create multiple income streams, invest wisely, keep learning, be patient, and protect your money. Follow these principles, and over time you can build real wealth. Remember, wealth is not just about money, but having financial freedom and security. Stay consistent and focused on your goals. Introduction to Personal Finance. Understanding Income and Expenses Setting. Financial Goals Budgeting. 101. How to create a budget. Building an emergency fund. The importance of tracking your spending. How to manage debt. Effectively. Understanding credit scores and reports. Debt consolidation versus Finanzziele setzen. Budgetierung 101. Ein Budget erstellen. Notfallfonds aufbauen. Bedeutung der Ausgabenverfolgung. Schulden effektiv verwalten. Kreditwürdigkeit verstehen. Berichte. Schuldenkonsolidierung. Debt Snowball Method. Creating a personal finance plan. The basics of saving and investing. Types of bank accounts and their uses. How to build credit responsibly. Smart ways to save on everyday expenses. Understanding taxes and tax planning. How to create a long-term financial plan. Investment strategies for beginners. Stock market basics. How to get started. The power of compound interest in investing. Risk and return in investments. Real estate investing for beginners. Retirement planning. Why it's important early on. Understanding different retirement accounts. 401k. RA. Diversifying your investment portfolio. How to save for big purchases. Car, house. Education. How to reduce living expenses without sacrificing lifestyle. Financial independence and early retirement. FIRE movement. How to set up automatic savings and investments. Managing finances in a relationship. Understanding insurance. Health, life, auto, property. How to build and maintain an investment portfolio. How to use credit cards wisely and avoid debt. Understanding financial statements and reports. How to improve your financial habits. Smart ways to pay off student loans. How to plan for unexpected expenses. The psychology of money. How your mindset affects spending. How to save money on utility bills. How to save for your child's education. Financial planning for retirement. Step by step. How to avoid common financial pitfalls. Understanding inflation and its impact on your finances. Investing in real assets, gold, precious metals, and more. How to build wealth over time. Principles to follow. How to protect your financial future. Estate planning and wills.